Welcome to the Deep Dive. We take your questions, your insights, like the ones you shared on Lifco AB's latest earnings call, and we turn them into clear knowledge.
That's right.
Today, we're diving into the Q2 FY25 results from Lifco. You know, the Swedish serial acquirer. Super diverse portfolio, dental, demolition tools, system solutions.
And this quarter, well, it brought some unexpected shifts for Lifco. The market definitely reacted.
Yeah, that sounds like it.
So we'll navigate through the numbers, what management said, and what this all means for that unique acquisition model they have. You'll get a really clear picture of the performance drivers and that investor reaction.
Okay, let's get straight into it then. Unpack these Q2 results. At first glance, Lifco's quarter looks like a material mess against expectations.
Pretty much, yeah.
Revenue landed at SEK 6.94 billion.
Correct. The consensus was closer to SEK 7.05 billion, so a definite shortfall there.
And the bottom line.
Also a miss. Diluted earnings per share came in at SEK 1.77. The street was looking for something like SEK 2.08. And on top of that, the EBITDA margin compressed by 140 basis points year over year. That's 1.4 percentage points down.
Right.
Settled at 22.5%. Seems like the System Solutions segment was the main drag there. And organic growth, barely there, just 0.5%.
Wow. Okay. That is a tough headline, especially for Lifco. Let's dig into those numbers a bit more. What really drove the softer sales and that hit to the margins?
Well, the overall sales growth was around 3%, and this is key, that was heavily driven by acquisitions. They chipped in about 7%.
Okay.
So that 0.5% organic growth, really minimal, shows some underlying softness. Plus, you had a negative currency effect, about 4.4%.
Right.
The margin squeeze, though, that largely seems to be down to a negative product mix effect. I mean, basically, the higher margin areas didn't do as well, while lower margin areas picked up some slack.
So kind of the wrong kind of growth for profitability.
Exactly. You saw that particularly in System Solutions and Demolition tools.
Okay, so that product mix shift hit the profit.
Yeah.
How did that flow through to their cash generation? Was that impacted too?
It was, yeah. Cash flow declined by 8.5%, partially because EBITDA was lower, obviously.
Makes sense.
But a significant chunk was also due to working capital building up. More cash tied up in inventory or receivables. And that was mostly in the contract manufacturing part of System Solutions.
Got it. Okay, with that overview, let's break it down segment by segment. Maybe start with dental. How did that hold up?
Dental sales were actually down 2% in Q2, and EBITDA was down 5%.
Oh, any reason given for that?
Yeah, management pointed to Easter being later this year compared to last year, said it messed up the quarter-over-quarter comparison.
The timing effect.
Exactly.
Yeah.
They stressed that dental is usually really stable, and this Easter thing shouldn't really affect the rest of the year.
Okay, so they see it as a bit of a one-off calendar quirk.
Seems that way, yeah. Historically stable, shouldn't impact Q3 or Q4 was the message.
Right. And what about demolition tools? That segment's had some challenges before, hasn't it?
It has. This quarter, sales grew 2%. There was some organic growth, but unfortunately, negative currency effects wiped that out.
But margin slipped a bit too, from 26% last year down to around 25%. Management said demand levels have kind of stabilized over the first half of the year.
So some improvement from lower levels.
Yeah, showing some organic growth picking up from where it was. They also mentioned, look, order books are short in this area, so Q2 results are probably a pretty good reflection of the market right now. And that margin shift, well, it's not totally out of line for demolition tools, which can vary quarter to quarter.
Understood. Now, you flagged System Solutions earlier as key to the margin compression. What exactly went on there?
Right, System Solutions. Net sales grew 7%, which sounds okay.
But
the real story is the huge slowdown in their contract manufacturing subdivision. That part grew like crazy, 95% in Q1.
wow.
Then slammed on the brakes in Q2 down to just 17% growth. And that deceleration directly hit EBITDA, which fell 2.8%, and squeezed the margin from 25.1% down to 22.8%.
That's a sharp slowdown. Very sharp. And there's this interesting detail, too. Almost a full percentage point hit to the margin came from something called onboard invoicing of surplus material.
What does that mean?
Basically, because growth slowed down so fast, they ended up with too much material they'd ordered based on earlier forecasts.
Oh, because of long lead times.
Exactly. So they had to invoice this excess material to customers, but without making any margin on it, just passing it through.
That's fascinating. The real consequence of that sharp deceleration meeting supply chain realities.
Precisely. Highlights the challenge of managing inventory when growth is volatile, especially with those long lead times.
Were there other issues in system solutions beyond that specific contract manufacturing point? Broader market stuff?
Yes. Management did mention weaker market conditions in other parts of that segment too, specifically things like environmental products, transportation products, special products.
What was driving that weakness?
They saw customers being less willing to invest in their products and solutions in Q2 compared to Q1. Just a general reluctance for bigger capital outlays, it seems. Not explicitly tariffs, but that kind of caution.
So a broader economic sensitivity creeping in?
Possibly. They did say activity in contract manufacturing picked up a bit during Q2, but the outlook for the second half is still pretty uncertain. For transport and special products, it was also partly just tougher comparisons against a strong last year, combined with that weaker demand.
Okay, let's shift to a more positive angle maybe. Lifco's known for its M&A strategy, right? Buying up niche companies. How's the balance sheet looking for more deals?
Very solid, actually. Their net debt to EBITDA is still only 1.3 times. That gives them plenty of financial firepower to keep acquiring profitable niche businesses.
Are they still active?
Oh, yeah. They've announced 9 acquisitions already this year, adds up to over $1 billion SEK in net sales. And they're sticking to their knitting, targeting high-margin companies.
So the acquisition engine is still running.
It is. Management acknowledges acquisitions can be lumpy. You might go months without a deal, but they're building capacity to look at more opportunities while still being prudent. Only great companies at reasonable valuations, as they put it.
Right, that disciplined approach, which makes the market reaction even more interesting, doesn't it?
Absolutely. Because the market, well, it hammered these results. The stock slid 9.3% right after the release.
Wow, nearly 10%.
Yeah, and on huge volume, more than triple the average. Investors clearly saw that weak organic growth and the margins slip as, serious cracks in what's often seen as a pretty safe, reliable acquisition story.
And it seems specific to Lifco, not the whole sector.
Pretty much. Other similar Nordic companies like AdTech or Lagercrantz, they only drifted down maybe 2-3%. So this felt very much like a Lifco-specific disappointment.
Okay, stark reaction. But then there was that twist you mentioned earlier.
Yes. This is where it gets really interesting. Remember, the stock had rallied 15% this year already, partly because it got added to the main Swedish index, the OMXS30, on July 1st, and Q1 was strong in the top line.
Right.
So this 9.3% drop wiped out about 2/3 of that gain. But here's the kicker. The CEO bought shares.
Oh, really? How much?
40,000 shares, worth about SEK 15 million. And he bought them pretty much right after the results came out amid that sell-off.
That is a strong signal. Insider buying right into the weakness?
Exactly. It signals real confidence from management that despite this quarter's bumps, the underlying value is still there.
Okay, that brings us to our favorite segment. This is not financial advice, purely for entertainment, conceptual thinking. If you were pitching an idea based only on this call, what wild yet plausible trade might you float?
All right, let's have some fun with this. Given that sharp market reaction to a miss that, look, it was significant, but it also had some identifiable, maybe temporary issues like Easter and that inventory thing.
And the CEO buy.
And the CEO buy, exactly. Plus the strong balance sheet for more deals. Here's a thought. Go long Lifco on this dip. Pair it with a short position on a basket of those Nordic diversified industrial peers.
Okay, explain the thinking there. A pair trade.
Right. The idea is that Lifco's discount now looks pretty deep, driven by what seems like a company-specific hiccup, not a whole sector problem. The CEO's buy suggests these issues might be transient.
So you isolate the Lifco-specific recovery potential.
Precisely. The short on the peers hedges against general market or sector weakness. You're making a bet that Lifco recovers from this operational blip, maybe normalizes that contract manufacturing issue, gets the mix right again, and keeps executing on acquisitions.
Leverages their financial strength too, perhaps.
Yeah, it's a bet on their specific serial acquirer model, proving resilient, bouncing back from this, maybe using their strong finances to keep buying well. It isolates the potential upside if this quarter really was just a stumble.
Interesting concept. Definitely not financial advice, folks.
Okay, what a dive into Lifco's Q2. Let's sum up the key takeaways. Clearly, a material miss on revenue and earnings per share.
Yep. And compounded by that margin compression, driven by the product mix and those specific operational challenges, particularly in system solutions contract manufacturing.
But, on the other hand,
the underlying acquisition models still seem strong, backed by a very solid balance sheet. And that CEO share purchase really stands out as a vote of confidence.
It really does. So it leaves you asking the question, doesn't it? Was this quarter just a temporary stumble for a company known for its resilience? Or is it maybe a sign of some deeper cracks appearing in that previously bulletproof model?
That's the million krona question, I suppose, something for investors to really chew on.
Indeed. And just a reminder, everything we've discussed today is purely for informational purposes. It is definitely not financial advice. Always do your own research.
Absolutely. If you have a topic or a source you'd like us to tackle in a future deep dive, please do reach out. Thanks for tuning in to the Deep Dive.